Okay, hi everyone. This is great. It's good to see some familiar names on this first inaugural Lafayette Square webinar. We've done many presentations before, but this is the first one in this type of format, so bear with me if there's any technical difficulties. This is a webinar, so I can't see or hear you. And it's 11:03, so it looks like everyone is here. I will go ahead and get started. First, I'll kick it off with a quick introduction. For those of you who don't already know me, I'm Erin Little. I'm the Director of Financial Planning at Lafayette Square. I will be a certified financial planner in just a couple weeks here. And those of you who already work with me know that I love crunching the numbers, and I love helping clients develop a financial plan and kind of digging into the weeds and making sure that their retirement and their financial goals are squared away. And sure enough, a very big part of the retirement planning process is Social Security, which is what we are going to cover today. So let's kick it off. Quick introduction to Lafayette Square. We are a wealth management company located in Walnut Creek. We primarily do 401k management. So we're advisors on a lot of 401k plans here in the Bay Area. We also do comprehensive financial planning and long-term investment management. So we help our clients make a plan and then invest according to that plan. And then we offer ongoing financial advice and account monitoring. What that really means is we're here to be your resource if you have questions about things like Social Security or college funding or mortgages or anything with a dollar sign associated. But today we are focusing on Social Security. So let's see. I will start with the basics. What is Social Security? Well, as you probably have noticed, if you've had a paycheck ever before, about 6.2% of your paycheck goes into this big government trust every time you're paid. Your employer is also required to contribute another 6.2% of your earnings into this trust. This trust holds all Social Security earnings, so not just yours, it's not individual, but everybody's funds go into this big bucket. While you're paying into Social Security, you're earning credits, and you can earn up to 4 credits every year. Once you earn 40 credits, typically that means 10 years of work, once you've earned 40 credits, you are considered fully insured. And this is the first Social Security term that I want you to note today. The status of fully insured is something you should know about yourself, because not only does it affect your Social Security benefits, it also affects the benefits if you were to pass on and survived by a spouse or survived by children. It will impact what they're paid, whether or not you are fully insured. So just take that note. Know if you're fully insured. So you pay 6.2% in, your employer contributes 6.2%. Generally, if you work for 10 years, you become fully insured. And then after 30, 40 years, you retire, and that government trust starts paying money back out to you. So they pay in form of a monthly paycheck. And unfortunately, you're not getting out exactly what you put in, but the amount depends on how much you contributed, your age when you started the payments, and the type of benefit that you elect. And that's what we're going to go through today. So the first thing I want to cover is how your benefit is calculated. And naturally, this is not something simple. The next few slides, just bear with me. It's complicated, but I hope this makes sense. I'm going to walk you through an example. So this is Sally. Sally started working at age 22. She was making $10,000 a year. She worked for a few years, had a baby, took a couple of years off, worked part-time for a few years, got back in the workforce, became VP here at 52. And then at 62, she started scaling back. She wanted to be part-time, and then eventually retired at 66 years old. So what this graph is showing is the income that she had every working year since age 22. And this is the first thing that the Social Security Administration will look at when calculating your Social Security benefit, how much you've earned over time. The next thing they do is take these earnings and adjust them for inflation. So as you know, this $10,000 that Sally made at age 22, in today's dollars, it's actually a lot more. It's more like $23,000. So they adjust every year of earnings for inflation to come to this inflation adjusted summary of earnings over the course of your working life. Okay. Once they have that, they take only the 35 highest years of your earnings. So in Sally's case, when she was 22, 23, or even one of these years where she cut back, those are not included in her 35 highest earning years. So what they do is they take those 35 highest earning years adjusted for inflation and add them together. And in Sally's case, that's 3.387 or $3.3 million is what she earned over those 35 highest years. Stay with me. I promise this will get easier. So they take that 3.3 million, they divide it by 420. And 420 is the number of months of 35 years. And what we're doing here is getting to the next Social Security buzzword. We're getting Sally's average indexed monthly earnings. And AIM, or average index monthly earnings, is probably something that you've seen if you've done any type of research in Social Security or in your Social Security statements. And in Sally's case, she earned $8,066 on average over the course of her 35 highest earning inflation adjusted years. Okay, so Sally's at $8,000. I wish I could say that they turn around and they pay you $8,000 a month, but what happens next is bend points are applied. And bend points increase every year. For 2023, the first bend point is at $1,115. So they take this $8,000 and the first 1,115 of Sally's 8,000 average monthly earnings, she gets 90% of that. So that's $1,004. The next 5,606 of this $8,000, she gets 32% of that. So that's 1,794. And then anything over, everything remaining up to a ceiling, she gets only 15% of that, which is $202. So we add these three together to get $3,000. And this is your third Social Security buzzword. Sally's primary insurance amount. And that is a very, very important thing that you should know. Your primary insurance amount is the amount that you get when you hit your full retirement age. Okay. So you're probably all thinking, well, what's my full retirement age? And I wish I could say, oh, it's 66, it's 67. But it is depending on the year you're born. And to reiterate, the full retirement age is the age where Sally gets 100% of that $3,000 per month. So hopefully you've stuck with me to this point so far. Full retirement age, if you were born before 1955, your full retirement age is 66 years old. That is the age, 66, at which you would get 100% of that $3,000 in Sally's case. You would get 100% of your primary insurance amount. If you were born after 1960, your full retirement age is 67. And that is the point at age 67 when you would get 100% of that primary insurance amount. Okay, so let's look at Sally. She was born in 1965. Her full retirement age is 67 years old. So at 67 years old, her monthly benefit is $3,000. And if she applies at age 67, she gets 100% of that $3,000. And why does this matter? Well, because you can elect to take Social Security early. You can elect to take it as early as 62 years old. However, every year early that you take it, this benefit is reduced, and it's reduced permanently. So if she decided to take it at 62 years old, she only receives 70% of her benefit. So she is locking in $2,100 as that baseline benefit for the rest of her life. It won't go up to $2,250 the next year because of her age, but she's locking in that lower Social Security benefit baseline for the rest of her life. Fortunately, if she decides to wait, every year that she waits past her full retirement age increases her benefit by 8%. So if she waits to 68, she gets to collect $3,240. She waits till 69, $3,480. And if she waits till age 70, which is the longest that you can wait, her benefit is increased 124%. and she locks in that $3,720 baseline Social Security for the rest of her life. And I say baseline because you lock in this kind of base here, but it does inflate. So if Sally, for example, starts taking at 67 years old, that's the $3,000 a month, she gets a cost of living adjustment every year on this $3,000 a month for the rest of her life. So the cost of living adjustment is something that changes based on inflation every year. These are numbers from the most 8 recent years of cost of living adjustments that Social Security Administration has put out. For example, in 2023, they increased Social Security by 8.7% because inflation was so high. But what this means is that if Sally started taking it at 67, in the first year, Social Security increased 2%, in the next year, 2.8, in the next 1.6%, 1.3, and so on and so on. So just 8 years later, her benefit has already increased to $3,960 per month. But it's all based on that first primary insurance amount that we locked in when she decided to start collecting Social Security. Okay, I hope that's making a lot of sense. So that very complicated 10 slides is how you calculate your benefit. But it doesn't stop there. The other thing that you really have to consider is what your spouse is eligible for, your spousal benefit. So a spousal benefit, we have another example here. We have Phil and Claire. Phil earns around $200,000 annually, and his Social Security benefit currently calculated is $2,000 a month. Claire, she works part-time. She's only earning $50,000 annually, and her Social Security benefit is calculated to be $800 per month. So what does that mean? Well, Claire, as the lower benefit and the lower earner, she can choose either her own benefit at $800 a month, or she can choose to take 50% of Phil's benefit. So 50% of Phil's benefit, half of 2,000 is 1,000 a month. The most important thing to note here is that's not 1,000 of his money that she's taking. It's just that she is able to increase her own benefit to half of his. Okay. This also applies if you are divorced. So in this case, Phil and Claire got divorced. Claire did not remarry. They were married for over 10 years, and Claire is 62 or older. She can still choose to take 50% of Phil's benefit, that $1,000, as an ex-spouse. Okay. There's also survivor benefit. So the survivor benefit depends on when your spouse passed away. If, in this case, Phil dies after age 67, after he hits that full retirement age, he is already collecting benefits and he passes away. At this point, Claire can choose to continue her own benefit, or she can elect to take 100% of Phil's benefit, which was stepping up to that $2,000 a month. Obviously, that's what she's going to do. She doesn't get to add it to her benefit. She gets to just take his instead of hers. Again, there's some rules around it. They must have been married at least 9 months. Claire cannot have remarried, and she must be at least 60 years old to do this. Okay. Well, what happens if Phil dies young? Maybe he died before age 67 and he hadn't yet been collecting Social Security. Well, in this case, Claire can still collect a survivor benefit, but it's only 82.5% of what Phil's benefit used to be, or would have been, which is, in this case, $1,650. Or she can collect her own, but obviously she's going to choose to collect the higher benefit of the two. Again, they must have been married at least 9 months. They must not be remarried, and Claire must be at least 60 years old. Okay, let's see. All right, so those are the basics. What I have here now are some very frequently asked questions. The first, when and how do you apply? Apply on Social Security or SSA.gov, and you can apply up to 4 months prior to when you want to start receiving benefits. You can still go to SSA.gov and set up an account and see what your benefit will be or estimated benefit will be, but you don't actually apply until you're about 4 months out from that point when you want to start receiving benefits. Okay. Next question we get asked a lot is Social Security taxed? It depends. What we do is we look at your total income, including Social Security, and based on where that falls out depends on how much of the Social Security is taxed. So for example, if you are married filing jointly in 2023, if you're making $32,000 or less, not just from Social Security, but from say rental income or part-time work or whatever it is, $32,000 or less, they're not going to tax any of that Social Security. If you're making between $32,000 and $44,000, they will tax 50% of Social Security. That's not to say that 50% is deducted and taxed out. It's to say they divide it in half and then they tax half of that Social Security payment. If you're making more than $44,000 a year as a married filing jointly person, 85% of your Social Security is taxed. Again, they're not taking 85% back. They are taking 85% of that Social Security and applying your rate that you would pay otherwise. Okay. Another controversial and big question that we get asked is, will Social Security be there for me? So you remember this slide. We're all paying into this big trust, and then this big trust pays out. The problem that we're having now is the baby boomers are the largest generation, and what we're paying in is not outflow. What's coming out to pay those baby boomers is more than what's going in. So $1 is going in, but $1.50 is coming out. Currently, the Social Security Administration, there's enough reserves to meet the promised benefit until 2037. And fortunately, after 2037, it's not that it goes to zero, it's just that there's only enough cash in this big trust account to fund 80% of the benefits. Okay, and that's, not great to hear, especially for younger people on the call who will be collecting far after 2037. However, most likely what is going to happen is some sort of Social Security reform. And what that means is they might increase taxes to include earnings over $160,000. So that would increase the amount inflowing into this trust. They might raise that retirement age, that full retirement age. Maybe by the time younger people retire, they're not able to collect until 70, 75. They might change the benefit formula. I don't really know, but this is kind of what's going on in the world. So to answer this question, yes, Social Security will be there for you. However, you should definitely consider your other sources of income and not expect it to be the one thing paying for your retirement. In fact, that's my next slide. Is Social Security enough to fund my retirement? The answer typically is a big no. On average, Social Security funds or replaces about 40% of your annual pre-retirement earnings. So, if you want to maintain the lifestyle that you have before retiring, then you probably need to figure out where all this other income will come from. Which brings me to this slide, considering your 401k, your other income, your IRAs, your pensions, and so on. And just making sure that you have everything squared away to fund retirement and you're not relying only on Social Security. Okay, next steps. What you should do now is understand your benefit. So go to SSA.gov and download this statement. Everyone should have this, no matter how old you are. It will have an estimate of your monthly benefit, and you can see how the monthly benefit increases as you wait to take it. It will have, a lot of details about disability benefit or spousal benefits and all this sort of thing. So I just highly recommend you have this statement, you're receiving this statement, you've at the very least set up an account. Next, do this for your spouse as well. It's important to understand your own benefit and also your spouse's benefit, especially if they were the higher earner. You want to go into the Social Security office knowing if you want to take that spousal benefit versus your own benefit. They won't necessarily guide you to the higher benefit. So, understand yours, understand your spouse's. And then third, make a plan. I'm a financial planner, so of course I have to bring this up. Think about those other income sources that you have, where your assets are located, how much you can pull from those assets, how you're saving for retirement. Is it enough to cover your living expenses? And just start asking yourself these questions. And, I know I can see a lot of these people on the call I've already done a lot of planning with, which is excellent and great, just what I want to see. But for those of you who haven't had the chance to do that yet, I highly recommend you get started. Actually, this is my final slide. By just laying everything out there. Greg and I just launched this really great new tool called Asset Map, where you can summarize all of your different income sources and your retirement accounts and all of this in just one really nice visual. This is no cost. It's not something we charge for, but it's just a really good first step in just organizing your information and getting a good idea of where you're at today. And that will help you kind of inform on what Social Security should look like. So, wow, I really flew through that pretty fast. Let me see. I don't know if I can do questions here. I have one question. Are IRA distributions counted as taxable income? Yes, they are. IRA distributions are included in your taxable income unless they are from a Roth. So that's another really great strategy to be thinking about as you're in retirement and as your income is changing every year, whether or not you want to be putting money into a Roth to avoid future taxation later. And if you have any other questions, just put it in the Q&A. Let's see. Okay, and then I have another question. When does Social Security adjust for inflation? Every year or just one time upon filing for the benefit? So let's see, I will go up here. It adjusts every year. There are years where they don't adjust it at all. So they will say, hey, inflation wasn't bad this year. We're not increasing your benefit at all. Or there's years like right here, this is 2023 or 2022, and that's 23. They popped up Social Security payments by 8.7% because inflation was so high. So generally, Social Security office is trying to keep your benefit paced with inflation. That being said, I don't think it quite paces with inflation. It's a little bit less. It's debatable. And we don't know how much it will increase every year moving forward. It's something that comes out every year. Okay. So if there's no other questions, then I will leave you with this and leave my screen shared for a few more minutes. And please feel free to give me feedback if you enjoyed this webinar or if there's topics you want to see in the future. The plan is for Greg and I to be running these monthly and just help educate everybody on these really complicated financial topics. But we're here if you need help with planning or this asset map thing or anything else. But otherwise, happy holidays, and I will see you guys next year. Thank you.